Welcome to Unit 4 of the Audit module. In this chapter, we'll be going through internal controls. So the first thing is just understanding, what is an internal control. So an internal control is basically a process within a company which helps prevent things that might cause a risk of material misstatement. So, for example, error or fraud. For example, I keep using the example of in the AAA team, that when an invoice comes through, to verify whether an invoice is a genuine business expense or one that someone might be potentially fraudulently putting through, you might have a process or a control in place. And that control could be anything really, as long as it achieves the objective of minimizing the risk of material misstatement within the business. So that control might be, when you receive an invoice, it might be calling up the person who sent the invoice and asking them what it's in relation to. You might be then going and checking that against someone in the business, saying whoever ordered that service. It might be maintaining a list of approved suppliers that once you've actually confirmed it, you've got a list. You can then refer back to the list. If it's a new supplier that we haven't seen before, that might be an issue. So there's no one right answer as to what a control is, as long as it achieves its objective. So the people responsible for managing and implementing internal controls are management and those charged with government. So the auditor doesn't need to obtain an understanding of all of the controls within the business, just the ones relevant to the audit. So the auditor's responsibilities relating to internal control is, number one, obtaining an understanding of the control, which helps the auditor to identify factors that affect the ROMM. The auditor then can then design further audit procedures to address these risks. Most auditors use a top-down approach, i.e. the auditor first understands the overall risks relating to the FinStats as a whole, and then it evaluates the design and implementation of those controls that relates to the FinStats as a whole, which are the entity-level controls. And after understanding the entity-level controls, the auditor understands an understanding of controls operating at the process level, e.g. controls in the sales, purchasing, or payroll processes. So these are the process-level controls. So the limitations of internal control. So the auditor may find that there are some risks of material misstatement that management has determined to be acceptable and consequently has not designed and implemented any controls in response to those risks. Furthermore, there are some inherent limitations to the effectiveness of internal controls, either in the design or operation or both. Because they are designed and overseen by management, who, along with employees of the company, perform some of the control activities. This opens the door for risk of material misstatement due to human error, management overriding the controls, or circumvention of internal controls through collusion of many people. For example, you might have a check and balance between two people, the AP person who's processing the invoice and the person they're checking with, for example, the CFO or someone in the finance team who approves the invoice. Now, what happens if the person approving the invoice and the person in accounts payable say to each other, look, I'll work with you, we can post our own fake invoices and go through the approval process, the checks and balances as well, because we're both in on it. So the first thing to recognize, and what auditors recognize, is that controls aren't perfect. And as a result, auditors always need to perform substantive audit procedures, which is something we'll talk about a little bit later. So these are more like the analytical tests and the checking and things like that. You can't, as an auditor, you can't purely rely on controls because of these limitations. So there's 5 components to an entity's internal control. So number 1 is the environment. Number 2 is the risk assessment process. Number 3 is the information system, or IT system. Number 4 is the control activities. Number 5 is the monitoring of controls. So let's talk about each of these different levels. So first of all, before we dive into those 5 things, entity level controls. This is across the whole entity. These are controls and commonly include relating to the control environment. Okay, we talked about that. So let's deep dive into each of these 5. So starting off with the control environment. So control environment is the tone at the top of the company. It means the attitude, awareness, actions of the entity's governing body and management concerning the importance of internal controls. So it's a message that needs to be pushed from the top down, that controls are important, that we're an ethical country, that company, and we respect integrity and honesty. So a weak control environment increases the risk that employees will bypass, override, or breach controls, whereas a strong control environment and ethical culture contributes to preventing fraud. So active participation by those charged with governance has an important role in counterbalancing pressures on management due to market expectations or remuneration structure. Examples of some top-down control environment examples. So number one is communication enforcement of integrity and ethical values. So entity level control example would be the company has a written code of conduct that is communicated to all employees. The code of conduct is approved by the board. Number two, commitment. Example number two is commitment to competence. So as per the company's training development policy, all staff are expected to attend regular technical training relevant to their role. For example, accounting staff are expected to undertake annual financial reporting training. And this is important because having competent staff with up-to-date knowledge reduces the risk of error in the financial statements. And the third example of the control, entity level control, is participation by those charged with governance. The company has an active and a competent audit committee, which is independent of management. It consists of independent directors with financial reporting and risk management expertise. The audit committee monitors the company's policies and procedures and so forth. So I won't go through every single one. I think you get the idea. You can read it in the textbooks if you want to read more. So when considering the control environment, the auditor considers the size and complexity of the entity. E.g. in a large organization, the auditor may find factors that contribute to an effective control environment and mitigate the risk of error and fraud. Whereas for smaller entities, the role of governance may be undertaken directly by the entity's owners and may not include independent outside members, and they may not have like a written code of conduct and so forth that you might expect from a larger company. Okay, if we go back to our list from before about the 5 components of an entity's internal control, so we've covered off control environment. Let's focus on risk assessment process now. So to fulfill its responsibilities, management should have an informal process for identifying, assessing, managing business risks and risk of fraud. The larger the organization, the more likely it is to have a formal risk assessment framework. So most risk management processes performed by management go through the following 4-step process. So number 1, identify risks, which is brainstorming all potential possible risks. Number 2 is assessing the risks. Number 3 is responding to the risks. And number 4 is implementing and executing the risk management plan, including ongoing monitoring. So risk documentation is a common output of management's risk assessment process, which is useful to auditors and may include a risk scorecard and or a risk matrix, which you might remember from the math subject if you've done that already. So this scorecard is basically a list of all the risks with a calculated score assigned to each specific risk. Okay, so moving on to the next element, which is IT system, including the related business process relevant to financial reporting and communication. Okay, so let's move on down there. So obtaining an understanding of the entity's IT environment. An entity's IT environment is basically the infrastructure governed by IT policies and procedures that are administered by the IT department. So the auditor must obtain an understanding of the entity's IT policies and procedures, department, infrastructure, and software applications. The IT department. So the auditor needs to understand how the entity's IT department works and how complex it is. So IT departments typically look after the 2 broad areas. Number 1, ongoing maintenance and support of the entity's everyday IT operations. And number 2, development of IT solutions to address business issues and support strategic initiatives. Why do we need to look at the IT? Well, there's 2 main categories of risks that arise from the IT team and why we need to understand them. So number 1 is data loss, which includes data corruption. So the impact is potentially a risk of material misstatement across the whole financial statements, because if the data is inaccurate or incomplete, it means the rest of the financial statements are also inaccurate and incomplete. Secondly, the second key issue arising from IT is unauthorized access to data. So, for example, use of confidential consumer data by hackers. This may pose a broader reputational risk, and of course, this would then eventually have financial impacts if people are sued if the government was penalties and so forth. So risks from IT often result in a change in the IT environment, for example, shifting from physical servers to in the cloud. And that's a key potential risk area. Or you might be changing accounting software. You might be going from MYOB to Xero or to your large enterprise software, and you might have a loss as a result of that. So general IT controls are policies and procedures that relate to many applications and support the effective functioning of IT controls. The auditor focuses on key GRTCs that support the effective functioning of IT application that the controls that the auditor plans to rely on. So interestingly, there's this unusual relationship between audit and IT that you wouldn't normally see because so much of what we rely on in the financial statements is a direct result of IT. Audit is probably the one area where there is a heavy reliance on IT professionals, IT people who work in the IT sphere in order to confirm that controls are correct, in order to confirm that there's a lower risk of material misstatement. So some of the things, and you actually need to be across this as part of your audit module as well, and we'll go through some of these later, like what are some of the controls that we might have in the IT sphere that can help prevent these issues or these risk of material misstatements in the financial statements. So here are some examples of elements of the IT environment which constitute controls. So there's the physical location or environment. So for example, access to physical location is controlled by a swipe card. Entry and departure of staff is monitored by security personnel. Servers are stored in a secure, tamper-proof physical location. Closed circuit cameras are used to monitor the physical premises. So these are all IT controls or general IT controls, which, it prevents a staff member going in and changing, the results because they can't access the actual digital IT infrastructure, which could be used to, defraud shareholders. There's also the hardware environment. So who can actually get laptop computers, whether machines are secured with physical locks, hard drives are encrypted and require valid usernames and passwords. Then there's network. So network access only available through wired connections or secure whitelist network and so forth. Then there's operating system. So username and password required to log on. And then programs, there's access to programs that's configured using operating system. There's a bunch of examples which you can read through. Because of audit's unusual reliance on confirming IT controls, and that can sometimes be, very complex, IT specialists may be involved with audits of, very large companies, so listed companies or companies with complex IT environments, or if there's been significant changes in IT systems or applications, or if significant risks arising from IT have been identified. In those situations, it might make sense for the audit team to actually bring in an external audit IT specialist. So these IT specialists might be involved in determining the effect of IT on the audit, obtaining and documenting an understanding of IT controls, environments and applications, or testing general IT controls and IT application controls. And they, of course, just like an auditor, they have to document everything they do. Generally, what they'll do is that they will do walkthrough procedures. So this is basically when you are going through the process that a client or a customer or someone would do and just seeing if the controls actually work. So I mentioned before the example of putting through a fake invoice and seeing if it gets paid. That would be a walkthrough procedure because you're actually doing the process as if you were a customer, putting through the invoice and then seeing if the controls pick it up as fake or not and allow it to be paid. Through some process level controls or IT level controls. So for example, the process would be sales, and the key assertion that we're testing for sales would be the occurrence and accuracy of revenue. So this is going back to our original assertion tables that we use for audit. And the other alternative, because we're using double entry bookkeeping, because if revenue is impacted, then accounts receivable is probably also impacted as well. So on the other side, we're also testing the existent accuracy, valuation, allocation. Remember, that's the AVA of accounts receivable. So So if you just for a little bit more explanation on that, so occurrence, if you remember, is whether or not the revenue has actually occurred. And accuracy is that whilst it has occurred, have we put the right amount or a dollar value to revenue? And then for accounts receivable is existence. So whilst there is accounts receivable on paper, does it actually exist in real life? Is there a receivable amount? And secondary, what is the accuracy, valuation, allocation? So yes, it might be recorded correctly, but is it recorded at the right amount? And you'll note that it's using the AAA, accuracy, valuation, and allocation, instead of just accuracy, because it's a balance sheet item, accounts receivable, as opposed to revenue, which is a transaction, which is just accuracy. So the controls the IT team might be testing for this is potentially number one, the sale is recorded only if the details, i.e. the date, customer description, price, and quantity, is recorded in the sales invoice, shipping document, and the customer order agree. If they don't agree, then it's not processed. Control number two is if details do not agree, an exception report is generated. The financial controller reviews the exception report weekly and investigates the exceptions. So the type of control, so the first control is a prevent control. So the control can either be manual, either details are agreed manually, or automated if the system is configured in a way that requires that details to agree. The second control is a detect and correct control. It is an automated control exception report with a manual component, which is the review of the report. Okay, so let's go through another example control. So in this situation, it's to prevent customers who buy on credit from not having the ability to pay for their orders. So the account or the process that we're dealing with is still sales. And then the key assertion of sales is the accuracy, valuation, and allocation of accounts receivable. Because we want to know, is our accounts receivable overstated, or do we have to impair it for bad debt potentially? So a theoretical control one is every quarter the financial controller reviews the customer's credit limits based on their payment history and produces a list of all customer credit limits. Control number two is based on the listing control one, credit limits for each of the customers are set in the sales ordering system. The system is configured so that it does not allow the customer's order to be processed if the order exceeds the customer's credit limit. This is a prevent control. The first control is manual, review of credit limits, and the second is automated. Controls. There's a number of factors to be considered by the auditors. So number one, is the control expected to operate effectively throughout the period of intended reliance? Number two is how well is the control designed? So a more robust control is more likely to be successful in reducing risk of material misstatement. Number three, has the control been implemented throughout the periods of intended reliance? Number four is what is the risk of material misstatement? So a higher risk of material misstatement may require the auditor to select more controls for testing, increase the extent of testing for the selected controls, and or obtain more relevant and reliable audit evidence about effective operation of the control. Keep on going with factors. So how many risks of material misstatement does the control address? What is the degree of reliance that the auditor intends to place on the control? So where a high degree of reliance is planned, the auditor will need to either increase the quantity and or quality of the audit evidence obtained in relation to the effective operation of the control. Does the control rely on other controls? What audit evidence is available to substantiate the control's effective operation? The auditor may recommend changes that would result in a more efficient and a more robust way to implement the control, e.g. bank recs monthly, not quarterly. And an auditor also must communicate any control deficiencies. So a control deficiency may relate to a control design or its operating effectiveness. A control deficiency in relation to a control's design exists when a control does not achieve its objective. Deficiencies in the operating effectiveness of controls are discussed later on. Since the presence of effective entity-level controls is necessary for the effectiveness of process-level controls, a lack of effective entity-level control is a common root cause of design deficiencies. Identified deficiencies in either the design, implementation, or operating effectiveness of controls, they are required to communicate these deficiencies in a timely manner to management and those charged with government. An auditor is required to communicate all significant internal and control deficiencies in writing to those charged with governance and, where appropriate, to management. A deficiency in internal control is considered significant when it or a number of control deficiencies considered together is of sufficient importance to warrant the attention of those charged with governance. Okay, so let's talk about when a client uses a service organization. So a service organization is when a company is effectively outsourced a key function. For example, they might have outsourced payroll to a payroll company, or tax compliance to an accounting or tax firm, custody and keeping record for certain classes of assets to a corporate secretarial company, and so forth. So this presents a potential risk to the auditors, or of potential risk of material misstatement that the auditors need to investigate, because there is a level of control over what's in the financial report that isn't within the control of the company itself. So the auditor has some obligations surrounding this, where there is a service organization being used. So the auditor must consider the services and effect on internal control and the design and perform of audit procedures. What the auditor will make in relation to service firms is effect on user entities' internal control, nature and materiality of transactions, interaction between user and the service organization, relationship including contract terms. They'll then evaluate all of this over the user entity's controls over the service organization. Now, if this understanding is obtained is sufficient, then the auditor understands the user's entity's use of service organization. If no, the auditor must obtain additional information from the service organization until they do understand. Does not gain sufficient understanding of the user entity from information located at the user entity, the auditor must then consider the controls and procedures in place at the service organization. So to obtain additional information from the service organization, there's a Type 1 or Type 2 report, which I'll explain below. There's the contact service organization, request specific information. There's visit service organization, perform relevant procedures. And then finally, use another auditor to perform audit procedures, obtain necessary information. And then just as a closing statement, explaining what Type 1 and Type 2 reports are. So Type 1 is the subject matter covered by these reports is the description and design of controls at a service organization. Type 2 report is a description, design, and operating effectiveness of controls at the service organization. So that's everything in Chapter 4, Internal Controls. I'll see you in the next chapter around materiality.